Good morning. My name is Ala McCoy. I am Director of Startup Support at University of Maryland's Ventures. And I would like to extend a warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series, both our live webinar audience here and those watching a recorded version on our Startup UMD YouTube channel. This workshop series is offered by Ventures at the University of Maryland in collaboration with MTech and Dingman Center for Entrepreneurship. To everyone attending the live session, please feel free to submit questions using the Q&A function at the bottom of your screen. Since we are recording this session, we have enabled anonymous, a feature where you can submit your questions anonymously if you wish to do so. So again, we are recording the session and it will be posted on our YouTube channel. So today's session is very interesting and very important. We will cover legal aspects of raising financing for your startup. I'm very pleased to introduce today's speaker, Anthony Millin. Anthony is a trusted legal and business advisor to startup and emerging growth companies. And as a startup attorney, a serial entrepreneur, a venture capitalist, and the chair of Next, powered by Shulman Rogers, he brings a unique legal and business perspective to advising his clients. Anthony, thank you so much for spending your time with us. The microphone is all yours. I'm gonna stop my video and mute my mic. I will be monitoring the Q&A session. And I'm here, but I'm gonna go ahead, stop and mute myself. And again, thank you.
Great, thank you, Ella. It's great to be here. I'm gonna share my screen. And if you could just tell me if you're seeing the full screen.
Yes.
Great. All right, it's great to be here with everybody today. As was mentioned, I'm Anthony Millin. I've spent the last 25 years in the startup ecosystem as a serial entrepreneur, as a startup attorney, and a venture partner in a seed stage VC fund. And I am the founder and co-chair of Next. Next is an innovative new model for startup services for the full range of startup companies from seed through Series A and into all the way through exit. We have productized legal services into a broad range of fixed price packages and service bundles to provide predictability to legal services. We have a next level customer services model with customer relationship managers and access to senior attorneys. We use technology to make things client-centric, much more transparent, efficient, and collaborative. And we also have a lot of other services available to help founders de-risk and grow their company. And we've been recognized as the Startup and Emerging Growth Company Law Firm of the Year. And for more information on Next, you can visit us at www.next.law. So in terms of raising funding, the place to start is really with the term sheet. A term sheet is usually the first document that is prepared and negotiated, and it highlights key terms of the transaction. And there are reasons for using a term sheet at the beginning of a transaction. One is it helps flesh out the key deal terms, and it enables early discovery of terms that could be deal breakers. You don't want to get 6 weeks into a negotiation and then discover that, or into deal documents to discover that there were issues you should have known about upfront. It makes it a lot easier if you've got a detailed term sheet to actually draft and negotiate the core legal documents, the definitive documents. And even though it takes some extra time up front, it reduces the overall cost and overall time of doing a financing. And it also makes it harder for parties to change their positions later, because you can always say this was already agreed upon when we did the term sheet. Term sheets are generally, though, not binding, but they can include some terms that are, and these include confidentiality. Sometimes you'll see an exclusivity period, governing law, and if you do have a binding portion of the agreement, sometimes attorney's fees. So to start off, what are the forms of securities that make up a company? One is common stock, and this could be voting, although sometimes you can see non-voting. And this is what founders will usually be issued when they form their company. If it's an LLC, it would be common units. Then you have preferred stock, which is Series C or Series A, Series B, Series C. The preferred stock has rights and preferences, and we're going to spend time today talking about that is above or superior to those of the common stock. There are also protective provisions over the common stock, and investors who are investing in a priced equity round are almost always issued preferred stock. And again, if this was an LLC, you might see preferred units. Another type of security that as a founder you may have heard about are convertible notes, and we'll talk about those. A more recent addition to the securities offered in seed stage financings over the last several years has become more popular as a SAFE, or a simple agreement for future equity. And then we can talk about warrants as well. So those are your securities that could make up a round. So the first one we're going to talk about is convertible notes. A convertible note is a debt instrument with interest, but that interest usually accrues. And it bypasses the need of a current valuation in terms of a priced valuation. You will have a cap, which we'll talk about, but you won't actually price the shares in a convertible note. So the key terms for a convertible note are the interest rate, which, as I said before, is usually accrued. It's added to the principal on conversion. The term of the note, or the maturity date, could be 2 years, 3 years, 18 months. The discount rate, which is when the convertible notes convert into stock in a priced round, they're going to convert at either the discount rate or the cap, whichever is better. So a discount rate of 20% means that if you come in at a 20% discount to the new investors coming into a priced round. A cap we'll talk about is the maximum amount that the investors will pay so they know upfront when they convert what the maximum amount is that they would convert at, or valuation they would convert at. Doesn't mean they're going to convert at that valuation if the discount gives them a better price, but it's the maximum. And then you have the conversion terms, automatic conversion, when it's voluntary conversion, what happens if the company sold before the maturity date, and what happens at the maturity date. The convertible notes are usually unsecured, but occasionally you see a secured note. And while they're outstanding, the convertible notes have priority over the common and preferred shareholders or unit holders in an LLC. So let's just talk about this concept of a cap, which many of you may have heard of, but it's an important one. A company with 1 million shares of common stock outstanding issues a $500,000 convertible note with a 20% discount and a valuation cap of $5 million. Founders are executing really well, and by the time they need capital again, they decide they're going to issue a priced round, let's just say a seed preferred, at a pre-money valuation of $10 million. So for the new investors who come in, they come in at a $10 million valuation. There are 1 million shares outstanding. It's $10 a share. They come in at, they would have 50,000 shares for the $500,000 convertible note if you came in at the same price as the new money coming in. But you don't. You come in at the discount of the cap, whichever gives you more shares. So in this instance, a 20% discount on 10 million is 8 million. So the share price would be $8 a share. And the convertible note holders would get 62,500 shares if they came in at the discount. At the cap, and this is where you see how a cap comes into play, they don't come in at more than 5 million. That's their maximum valuation. So that's $5 a share. and they end up with 100,000 shares. So you can see if they didn't have a cap or a discount, they would have 50,000 shares and come in at $10. If you just use the discount and no cap, they would come in at $8 a share with 62,500 shares. But in this instance, since there was a cap, they're going to elect to come in at $5 a share and get 100,000 shares. So that's how caps and discounts work. A simple agreement for future equity or a SAFE has the same concept of a discount rate and a cap as the convertible note, but unlike the convertible note, there is no interest or maturity date. It still converts on the next equity financing at the discount rate of the cap. If you sell the company before the conversion of a SAFE, you usually receive some multiple, like 1 times your money back or 1.5, or you convert to common stock at the cap value and participate in the sale of the company, or deemed conversion and participation in the sales proceeds. You have no rights of a stockholder until conversion, although you could put in the SAFE agreement that if there are any dividend rights granted and dividends issued, that the SAFE holders will have dividend rights and participate in dividends, even though they're not stockholders yet. And you have priority over common and preferred shareholders, the same as the convertible note holders do. A warrant is another security. It's a derivative that confers the right but not the obligation to buy what's normally equity securities at a certain price before expiration. So a little bit like an option. Often you will use these as an incentive for investors moving first or quickly, or a strategic partner tied to a strategic transaction can often be issued warrants. The key terms in a warrant is whether it's you're going to you exercise your warrant for common or preferred stock, the number of shares that can be purchased, so the right to buy 50,000 shares, the exercise price, so what price you can purchase those shares. Let's just say this is a 50-cent warrant. You buy shares at 50 cents. The terms, so how long you can wait to see if the company does well before you need to exercise your warrant. That's the term. So 5 years or 10 years are examples. And then in a warrant, often you have a cashless exercise where instead of actually paying money to buy the shares in exercising your warrant and then selling, you just take the differential between the exercise price and the sales price. So with a warrant, it's really upside that you get to wait and see. If you've got a 50-cent warrant, you can wait for the company to be worth $10 a share before you exercise or buy them at 50 cents and sell them at 10. So that's how warrants work. There are 3 main areas or negotiating levers when you're negotiating with investors as a founder. The first area of negotiation is around the value of the company. And this is where founders spend most of their time focused on. What is the value and how much of the company, what percent of the company am I selling? And this is driven in a price round by the price in a round, the equity, the valuation, and or as you saw before, how caps in convertible notes or safes come into play. Investor rights and preferences. So these are where investors spend a lot of their time thinking about, even though founders, unless they've got strong legal representation, may not spend as much time focusing on these very important terms. But these drive the investor's preference with respect to distributions of profit or distributions upon a liquidity event. They drive the investor's right to participate in new issuances of securities and to transfer of issued securities. Then you have the protections or control provisions, and these drive the level of control an investor who usually only holds a minority interest in the company, let's just say 10% or 15 or 20%, but gives them the ability to have, in essence, veto rights on major actions of the company as shareholders or a group of the majority of the shareholders in that class of preferred stock, a requisite majority, and through board seats. So again, founders spend a lot of their time on the valuation and the value and the amount of shares. Investors spend a lot of their time thinking about investor rights and preferences and investor protection provisions. And it's important for founders to really be familiar with these as well. In terms of the value of the company, there are two key concepts. You have pre-money versus post-money valuation, and looking at the value of the company, the share price on a fully diluted basis. Pre-money valuation is the valuation of the company, not including new cash to be raised. And post-money is the valuation, including the new cash to be raised. So you could have an entrepreneur who comes in and they're raising $500,000, and the investor and the entrepreneur agree on a valuation of $2 million. The question is the $2 million pre-money or post-money? And that's a really important question to know as a founder ahead of time. If it's pre-money, then the business is really worth $2.5 million when you close on the funding, and the investor will receive 20% of the company. $500,000 they invested divided by the 2.5 million, the 2 million value and the 500,000 cash. If it's post money, then what you're saying is the business is worth 2 million upon closing. It was worth 1.5 before closing, and when you put the 500 in, it becomes worth 2. So the investor would get 25% if the 2 million is a post money valuation, 500,000 divided by 2 million. So you can see the difference in this example between pre-money and post-money is 5%, or a significant material percentage of the company. Fully diluted is another really important concept. If you look at your term sheet from an investor, it's almost always going to say that the share price is being calculated on a fully diluted basis. So when you calculate the share price, you're dividing the valuation by the number of shares outstanding. But what goes into those shares outstanding if it's on a fully diluted basis? Should it be issued in outstanding shares only in that calculating that share price? So what's actually issued in outstanding today is stock. What do you do with the stock options that are in your plan, your option pool, that haven't been granted or granted but not yet exercised? These aren't shares yet. Do you count those? We just talked about warrants. What happens if somebody has a warrant to buy 50,000 shares? Should those 50,000 shares be included? The answer is, with a fully diluted basis, all of these are included. And so investors will almost always require the calculation be on a fully diluted basis, which ensures that if you're issuing shares in the future through your equity plan or through warrants at a lower price, the investors will not be diluted by that. And that's why they want the fully diluted, and they want warrants and stock options reserved and not yet issued to be in the calculation of the share price. So just to give you an example of how it actually plays out, if you have 2 million shares outstanding and you have 500,000 shares in your option pool that have not been granted yet, for example, and somebody invests 500,000 at a $2 million pre-money valuation, if you only base it on the shares outstanding, there are 2 million shares outstanding. So the share price is the 2 million valuation divided by the 2 million shares outstanding, gives you a share price of $1 per share. And if you're investing 500,000 at $1 per share, you're going to have 500,000 shares. But on a fully diluted basis, you divide the pre-money valuation by the sum of the shares issued and outstanding, plus, in this example, the options in the pool. So you divide the $2 million by 2.5 million shares on a fully diluted basis. Same 2 million valuation, but you can see now the share price drops to 80 cents a share. So the same $500,000 investment on a fully diluted calculation means the investors for the 500,000 get 625,000 shares instead of the 500,000. So 125,000 more shares. Again, a very material amount, and one that makes it really important to understand the impact on a fully diluted basis calculation is going to have when you're figuring out your valuation. Now let's turn to rights and preferences. In the long run, these are often more important than the valuation. And we'll talk about some of these today: liquidation preferences, which could be participating or non-participating. We'll talk about preemptive rights, information rights, drag-along rights, and anti-dilution rights. And there are others that we won't have time to get to today: dividend rights, rights of first refusal and co-sale, redemption, registration rights, and rights to a board seat. So the liquidation preference is a mechanism where the investor seeks to recoup its original investment or a multiple of its investment, plus any declared and unpaid dividends before any distribution to the common stockholders. Usually it's defined to occur upon some liquidation, dissolution, or winding up of the company, or a liquidity event like a merger or sale. So if somebody invests $1 million and they have a 1x liquidation preference, then they get $1 million back to the investors before the common shareholders get their first dollar. If your term sheet reads a 2x liquidation preference, what the investors are saying is they get $2 million back before the common shareholders get their first dollar. The participating versus non-participating preference is really important as well. If you have non-participating preferred, what you're saying to the investor is you can either get your money back if it's a 1x liquidation preference of 1x their money back, or they can convert to common stock and get their, just say, 20% of the equity in the company and share in the sale proceeds of the company based on that ownership. But they have to pick, and they'll pick whichever one gives them more money. Participating preferred changes that, where the investor is saying, I get both. First, I get my 1x the money back if it's a 1x liquidation preference, and I get to then convert to common stock or be deemed to convert and share in the proceeds of the sale. So this is really significant as a founder to understand if the investors are asking for non or participating. And the challenge of the participating preferred is it sets a preference. So if you raise $1 million and give up participating preferred up front in your first round, then you go and you raise 10 million, those investors are going to see it and ask for it too. Now you're up to 11 million. And then if you raise a 30 million round as your next round, now you're at 41 million that has to go out the door before everyone converts and participates, including the investors who took the 41 million out the door before the conversion. So it's normally market not to have participating preferred, to have non-participating, but it's important to be on the lookout for that term in your term sheet. Preemptive rights are common. You see it very often. This protects the investor against dilution from future financing, where the investor's pro rata right based on their equity ownership to participate in future issuances, usually financing. So if the investor owns 20% of the company before your next financing, they have the right to take 20% of the next financing, which would keep them at 20% of the company. And you need to understand the impact on future rounds. If you give up to everybody these preemptive rights and a new investor, a large new investor wants to take 90% of the round and you've got preemptive rights out there for 30%, then you're forced to go back to existing investors to get waivers from their preemptive rights. So often you don't give all your investors these preemptive rights, just major investors, where you may say only investors who invest at least 250 or 500,000 or whatever the number is based on the size of your round. Information rights are important because it's really important, even if you didn't have these, to keep investors informed of the business and its performance. But these are legal obligations where you build into the documents the investor's right to receive financial information such as income statements, balance sheets, and cash flow statements. And these could be unaudited or audited financials, and they could be on an annual, quarterly, or monthly basis. They also may negotiate for other rights, other information rights, such as rights to budgets, key financial metrics, and you're always weighing the investor benefits versus the burden on management to produce these. Like I said, it's good business practice, but whether they should be quarterly or annually or monthly is what you're weighing. And sometimes investors will limit this also to, companies will limit this also to major investors who are investors who've invested at least a defined amount of capital in the round to get that classification. Drag-along rights are really important. The rights of a certain number of selling shareholders who all agree to sell, and that could mean, you know, a majority of the common stockholders, a majority of the preferred stockholders, and the board, whatever your trigger is. Then if that trigger is triggered, then everybody agrees up front based on agreements they've signed to be dragged along into that sale. So you never left with a person who says, well, I'm not selling, and tries to hold up the whole sale when the other 95% of the company owners want to sell. And so it really stops a small stockholder from having a veto right over the sale of the company. And so an important right to make sure that's in your legal documents. Anti-dilution protection, there are 3 different kinds. There's a full ratchet. If somebody comes in and buys in a round at $2 a share, and then in your next round you raise money at $1 a share, a full ratchet moves all of that prior $2 investment to be the equivalent of $1 investment. Broad-based weighted average says, well, you not only look at the price, but how many shares did you issue in that round at a lower value, and what amount is that of all the shares outstanding in the company. So it takes this weighted average concept and creates a ratio. And so even if you go from $2 down to $1, if it was a small number of shares and a small percentage of the overall company, the drop may not go all the way from 2 to 1, but to somewhere in between there. Narrow-based is just another method of calculating a weighted average that only takes into account what's outstanding, whereas broad-based takes into account what's issued and outstanding on a fully diluted basis, which is a concept that we talked about before. So broad-based is most favorable to founders, and it's what you usually see. Protective provisions in the long run are often more important than valuation as well. These provide investors who control less than 50% of the shares or less than 50% of the board seats with significant say over certain designated or agreed upon actions of the company. And so where you have a protective provision, it usually requires the approval of a majority or supermajority of the preferred shareholders voting as their own class, or if it's a protective provision at a board level for a preferred stockholder or investor's board member, you need approval of that preferred shareholder's designated member on the board. So you can see from a management operating perspective of the business, this is really important in terms of what these are. So for instance, you could have a protective provision that says the company, without the approval of a majority of the preferred stockholders, cannot amend their certificate of incorporation or bylaws, or can't redeem shares or repurchase shares, or can't change the nature of the company's business materially, or can't change, like increase the size of the board, can't issue new stock or new convertible securities that are equal to or greater in preference to the equity the investors hold. You could have clauses around hiring and firing key employees or changing compensation of founders. You could have something that says the company cannot incur debt above $100,000 without the approval of a majority of the preferred stockholders. You can have clauses that say that you can't sell the company without that approval, or you can't liquidate, dissolve, or wind up. So these are areas where sometimes there's not a lot of negotiation room, and some of these are standard, but around others, they may be around the edges, some things that you can negotiate with investors, and it's important to understand the impact of these clauses. Okay, now we're going to go into due diligence. So you have business due diligence around the core business. You have financial due diligence, which you may be working with your accountant to prepare for. And then you have legal due diligence. And in legal due diligence, you're going to cover corporate structure. So the whole corporate structure, your formation documents, the founder shares that were issued, whether you had the organizational board meetings done correctly, all of that is going to be looked at. Then investors are going to look at your cap table and make sure everything in the cap table has documents behind it. Everyone is accounted for, every option, every warrant, every equity grant, every share, every convertible note, every safe has to be accounted for in your cap table. And they're particularly looking to see if you've promised people early on shares because you didn't have cash to pay them, and if those promised shares are recorded and captured in the cap table. They're going to look at the team and try to make sure if somebody is a consultant or independent contractor versus an employee, if they were classified correctly under the state employment regulations. You're going to look at for material agreements with customers or strategic partners. They're going to look at IP like patents and provisional patents and trademarks and copyrights and other IP. And then they're also going to look and understand any sort of regulatory or litigation risks. And this process is so important. Every founder should know that if they're going to raise money, they're going to go through due diligence. And the more organized and prepared they are working with their legal counsel and the legal due diligence and accountants on the financial to be prepared and make sure your data room is set up, that all of your documents are marked correctly, that you've got a catalog of everything that's in there, that you don't have anything in there that's going to be a problem that should have been corrected or cleaned up before due diligence started. Because if it goes really smoothly, it really boosts the confidence the investors have in the company. And if there are issues in due diligence with the documents and problems that weren't corrected ahead of time, then investors start worrying about if they caught these problems, what are all the problems they didn't see yet or that they may have missed, and they can really have a much more negative feeling about making the investment. In terms of the definitive documents, so what are the legal documents that would be prepared and drafted? In a if it was an LLC, you would have a membership unit purchase agreement and an amended and restated operating agreement. In a Series C preferred financing, you would have a stock purchase agreement and amended and restated stockholder agreement, although often that is also broken out into an investor rights of first refusal and voting agreement. But a more simple version of those than you would have in a Series A round, and then an amended and restated certificate of incorporation. By the time you'd get to a VC A round, you have the stock purchase agreement as well. In these, people often follow the National Venture Capital Association NVCA form set, which breaks the shareholder agreement or stockholder agreement into an investor rights agreement, a right of first refusal and co-sale, and a voting agreement. And then you have the amended and restated certificate of incorporation. And then you may have, if the investors are going to serve on the board, an indemnification agreement to indemnify their director. Sometimes you have legal opinions where you're giving an opinion on the cap structure, and you may have management rights letters. For a convertible note, you're going to have a note purchase agreement, a convertible promissory note, Sometimes those are combined into one document, but often you see them as two different documents. And then the SAFE is just a simple agreement for future equity and is usually just one document. And then around all of these, you have your corporate resolution, so board or shareholder resolutions, depending on what deal and what's been agreed to with existing investors before in terms of the shareholder side, but definitely you would have the board consents for these rounds to happen. And then you go into regulatory compliance. So every time you raise money, it could be a friends and family SAFE or convertible note or a seed round or an A round, you always fall in under security regulations if you're raising money for your company. And the ability to raise money from investors is regulated by the Securities Act of 1933 and state security laws. Under Section 5 of the Securities Act, all issuers, meaning the company issuing equity in their company or convertible note or a SAFE, so issuing a security, must register non-exempt securities with the SEC, and registration is very expensive and very time consuming. So as an early stage company, you're looking for an exemption to the filing, to the registration. Section 4A2 of the Securities Act says that the registration requirements of Section 5 do not apply to transactions by an issuer not involving any public offering. And so they were developed under Rule 506 of Regulation D, and you may have heard of 506B and C and Reg D. If you've been working with startups before, what these are is safe harbors for issuers or companies issuing securities to rely on to meet the 4A2 private placement exemption. 506B, which is a private offering, is the most commonly used exemption, but you cannot broadly solicit or generally advertise if you're under 506B. 506C is more recent, and you can broadly solicit and generally advertise, but there the third-party accredited investor verification is very stringent, and there's stated exactly what you need to do. You need to do a lot to make sure you have properly verified investors in compliance with the regulations. Then you file the Form D with the SEC, where you indicate what you're filing under. And then you have to look at where the investor is located to see what security filings are required within the states in which the investors reside. So we covered a lot of material today. And what I'm going to do is stop sharing, and then I'm going to open this up for any questions people have on either anything we covered in the presentation or things related to the presentation, but were maybe not covered in it.
Thank you so much, Anthony. That was a very interesting and presentation covering a lot of topics. So at this point, everyone's invited to submit questions either using the Q&A function, or you can also raise your hand virtual. There's a button that says raise hand, and I can unmute your mic and you can ask your question via microphone. But to begin with, I don't see any questions. I can start. So can you talk a little bit about who are the qualified investors, and why does it matter that investors need to be qualified?
So there are regulatory requirements for accredited investors that have to do either with their net worth, so what their net worth is excluding their principal residence, or their income, if these are individuals over the last 2 years. And then if you're a fund or other groups, you have different types of requirements for what's accredited. But the accredited investors requirement is there to really protect investors in these financings. And if you have non-accredited investors in a round, whether it's a 506B or a 50, in the 506B round where we talked about it, or where you have to do strict verification in the 506C, if somebody is not accredited in the 506B section, you have very significant registration requirements as well. Even though you are allowed a certain number of non-accredited investors in a 506B round, you will have significant costs and efforts in disclosures because of that. And like we said, in the 506C, everyone has to be accredited, so you can't do a round with non-accredited investors. So that's why you will normally see legal advisors talking about really wanting to make sure that you have accredited investors in your private rounds that you're raising.
Thank you. That's really helpful. So for everyone listening, it's really important to talk to your attorney to make sure that anybody investing in your company is an accredited investor. Otherwise, it would add paperwork and cost. It's okay to take them on, but it's just going to cost more.
It's significant, sometimes for an early stage company can be prohibitive in terms of the complexity. So you're better off just making sure that people are accredited investors is what we usually recommend.
Okay. Could you talk about the possible tax advantages of creating making your company into a corporation versus an LLC in terms of the potential tax savings for investors down the road?
So the big difference between deciding whether to be an LLC or a C Corp is based on several key trigger decision points. One of the things you're going to look at is, when do you think you're going to be raising a round of institutional capital? So when do you think you're going to bring in some sort of organized institutional investors into your company? Because VCs and other institutional investors will very often not invest in an LLC, because in LLC is often you have the pass-through tax of profit and losses passed through to the investors. And so VCs do not want to have that. So they'll almost always require a C Corp. And if you're already an LLC, for you to convert before that round to a C Corp. Another decision point between a C Corp and an LLC is if you plan on having a growing number of employees and you want to issue equity, stock options, to allow those employees or consultants or advisors to participate, but particularly the employees to participate in the growing value of the company. Since many people are paid below market salaries for the benefit of sharing in the upside through options in a company. So in a C Corp, you can have incentive stock options, which have a lot of tax advantages and are more frequently used and more understandable for employees. You can mimic that in an LLC with unit appreciation rights, which get created, but those are more complex, and most people who've come from other startups where there were options don't fully understand them always, and they don't have the same tax benefits. They're almost like a bonus, a bonus plan. You don't have some of the benefits that you can have or that are potentially available. So if you're going to bring on employees and have stock options, then you also would choose often to be a C Corp. Then you have 1202, a qualified small business stock qualification under Section 1202. So under Section 1202, if you're a C Corp and the shares are held for at least 5 years, there's significant tax benefits, again, upon the sale of the company. Those 1202 tax benefits are not available to LLCs. So people will often want to start the clock on that 5 years and be a C Corp for that. So those are strong reasons to be a C Corp. On the LLC side, the main tax benefit is that if you're going to have losses early on and you want to pass through those losses to the individual founders, in an LLC, you can pass through those losses. And also you don't have the double taxation in a sale under certain types of sales structures that you would in a C Corp, although with the corporate tax rate dropped with the last time you had changes in the tax code. So with the lower corporate tax rate, that difference between an LLC and a C Corp is not as significant as it used to be. So a really important analysis. It's facts and circumstances driven, and really important to work with your legal advisor and make the determination of should you set up as an LLC or a C Corp upfront, or if you're an LLC, when is the right time to convert to the C Corp.
Thank you. If anybody has any questions, please feel free to submit them or raise your hand. Yeah, happy to unmute your mic if it's easier to talk than to write. But I don't see any questions submitted. We will be posting this session on our YouTube channel. So to those who were not able to attend, you will be able to watch it that way. And feel free. So Anthony provided his contact information. Feel free to reach out to me and I can put you in touch, or feel free to look at the Next Powered by Shulman Rogers website and ask questions that way.
Great.
Do you have any parting comments? Do you have any parting comments for us?
Yeah, I just want to say, feel free for anyone who attended or who's listening, if you have any other questions that you feel like you want to answer, feel free to reach out. My email is on the presentation that you'll get a copy of. So I'm very reachable if you want to follow up, and if you want to look at our website, it's www.next.law. And thank you so much for having me here today.
Thank you so much for spending your time with us and sharing your expertise. It's a very, very important topic. It's a lot. So thank you so much, and have a really good day.
Thanks. Bye-bye.
Bye-bye.